Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of GeoData Vision.
Good day, everyone. This is Len Suzio with GeoData Vision, joined today by Dean Stockford of M&M Consulting, and we want to welcome you to our podcast series discussing everything you wanted to know about regulatory compliance, but were afraid to ask. Dean, we just completed our 100th, 101st, and 102nd episodes with two outstanding guests, Dr. Ken Thomas and Lori Summerfield. We have listeners in all 50 states and in 4 different countries. So what exciting topic did you bring to the group today?
Well, Len, it's great to see you again today. And yes, we've been very fortunate with respect to our podcast guest, and I think they were a huge hit. But let me cover something else I think that is equally important, and flood insurance enforcement actions are apparently showing no signs of slowing down, and the apparent struggles that financial institutions have complying with these provisions is certainly something we've been seeing on a regular basis. So I thought I'd provide a refresher or overview of the areas that are presenting the greatest challenges.
Well, that sounds to me like it's a great topic. In fact, I heard you touch on this at M&M's recent Compliance and Risk Conference up there in Maine.
Yes, I did. I actually covered some of the hot issues that we're seeing in flood amongst a myriad of other things, and provided guidance that was surrounding how we comply, and I plan to highlight some of those today in this podcast.
Well, I think that's a great idea. So let's jump in.
Yeah, let me first provide some insight. I think, I'll say around the statutory requirements. I think it's important to start with our baseline. So the statutory requirements apply when we have improved real estate, that is a building, or manufactured mobile home is taken as security for a loan. And lenders have certain responsibilities that they have to follow from the time that it's initiated all the way through. The first thing they need to do is determine whether the building or manufactured mobile home offered as security for a loan is or will be located in a special flood hazard area. And this should be done early in the process. Regulators are on record of saying a reasonable period of time is 10 days. So that's what they interpret it to be. That's what it should be. So we want to make sure that we're making that determination early in the application process. Document that determination on a flood hazard status, whether the building is in a low, moderate, or flood risk area for special flood hazard. There is a standardized form that is used for that. It's updated periodically, but we need to make sure that we're documenting those determinations on the standard flood hazard determination form as provided by FEMA. We need to provide notification to the borrower if collateral is or will be located in the special flood hazard area. And that should also be a specialized sample notification, or I shouldn't say a sample, but there is a sample notice that is put out by, of course, FEMA, and that is the notice that we should provide. And I think, the real hiccup here in the notification requirement, Len, is proof of receipt. It's not proof of mailing, it's proof of receipt. And I think that's where institutions sometimes get hung up. And so make sure that I always say return receipt requested, and that takes all the guesswork out of it.
That's an important distinction.
Yeah. Require that adequate flood insurance be obtained for buildings in the special flood hazard area. Once again, this has been an area of issue only because, and I'll have to say, I think it's because of the guidance that's come out. We have a replacement cost value, and as we all know, that a lot of times when appraisals are completed, they don't include the replacement cost value. So people are taking, I always say, the old methodology, taking an appraisal, taking the land or subtracting the land from it, saying this is the amount of coverage. Well, that's wrong, and it shouldn't be that way. So we have to follow the guidance and make sure that we have replacement cost for those buildings. And it's critical that they calculate that accurately, because that dictates everything else as we move forward. We also have to be concerned with requiring or the provisions that require escrows of flood insurance premiums. If escrow is required for other items such as hazard insurance and taxes, then we have to also require that flood insurance be escrowed as well. During the term of the loan, they have to make sure flood insurance is maintained and obtained. If the lender becomes aware that any of the insurance has been dropped or that they don't have adequate insurance, then they have to force place or follow forced placement procedures. But monitoring is critical, and they have to reconcile. When I say the financial institution needs to be able to reconcile those lists with their outside vendor to make sure that all loans that should be tracked are, and those loans that have paid off are no longer being tracked. So a consistent reconciliation of that is imperative. And as I indicated, forced placement, we cannot delay forced placement, and it's required if the borrower allows the policy to lapse or the policy is inadequate. And I just want to expand on that too, because there's two issues that we're seeing on the forced placement. One of them is when you tell somebody that you're going to force place insurance by the 46th day or after 45 days, then you better do it. Regulators are steadfast on, if you tell somebody you're going to do it, then do it. Don't do something different. That's where it gets you into trouble. So force place on the 46th day. So the second issue, Len, as I was indicating with force placement, is NFIP only allows one policy on the building or on the structure. And what we've been seeing of recent is where a borrower provides a financial institution with inadequate coverage in the form of a policy, and then the financial institution then turns around and goes and procures a second policy for the difference. Example, I just had one the other day where the amount of required coverage was $206,000. Well, the borrower provided a policy of $200,000. The bank then turned around and went and got a forced placement policy for $6,000 because the borrower didn't provide adequate coverage and didn't respond accordingly to the notification of forced placement. And that's not allowed under the requirements. Technically, the way that it reads in the NFIP policy or guidance is that they have to cancel the earlier policy, and in this case would have been the borrower policy for the $200,000, and then the bank would have been required to again obtain a policy in the amount of $206,000, which was the adequate coverage for that particular transaction. It's kind of a dicey situation, but we actually went to the FDIC several years ago on this particular issue, and we said, well, what happens if the borrower is unwilling to cancel that first policy? And the FDIC kind of surprised me a little bit, but they said, call the note. I mean, because you have provisions in the note and they're not complying. So they said, call the note. So it's
pretty drastic. Holy
it's a drastic stance. There's no question about that.
Yeah. So, well, Dean, these guidelines seem pretty straightforward. So why do you think financial institutions appear to struggle with this compliance?
Yeah, I agree with you, Len. I think the provisions seem relatively straightforward, but we continue to see, numerous violations with some resulting in significant civil money penalties to the institution. So I can't really put my finger on exactly what drives non-compliance. But in my opinion, I think the primary factor is flood does not have any specific written regulation, and we find varying degrees of interpretation from a myriad of sources, and in particular, the regulators themselves.
Wow. I didn't realize there are no regulations governing flood provisions. Did I understand that correctly?
Yeah, you did. And it's actually, flood is actually a series of laws and guidance documents and financial institution letters and Q&As and so on and so forth, which taken together are really the closest thing we have to regulations, but they certainly leave much for interpretation. There's no question.
Well, boy, I could certainly see why the confusion. Anytime you leave that much room for interpretation, it definitely creates confusion. It kind of, Dean, reminds me of the REMA issue, by the way, the reasonably expected market area when you talk about fair lending and redlining, which was, basically became a big issue in the last few years. REMA is not defined anywhere. And So the regulators are free to play around with it, and they did. They changed the way they defined it, and a lot of banks got caught, unfortunately, in a very difficult situation because of the ambiguity surrounding the term REMA.
Yeah, I agree, and I think that's, when anytime you leave that level of interpretation open, you're bound to have issues. So let me actually address some of these. I'll jump into a little bit more specific on some of these, but I think a vast majority, and I'm not speaking for everybody, but a vast majority of the issues that we have seen relate to commercial properties in contents coverage. And again, sounds pretty straightforward, but issues exist with all aspects. And the primary issue is when we have what we call blanket security instrument provisions, which require that all contents fixtures as collateral are securing the transaction. But yet when you start looking at the information within the walls of a file, you see, well, geez, the bank or the financial institution didn't intend to take contents. There's no write-up about contents, but yet because of blanket provisions in these security agreements, they're required to have it. And we have seen, I say we have seen regulators from agency to agency waffle a little bit on this particular issue. I've seen one regulator say, well, as long as your file information is clear that your intent is not to secure the contents, then don't worry about the provisions. Well, I've also seen regulators take it to the other side, which is if it's in your security agreement, you darn well better have contents coverage. So, and I think that's been kind of the common thread that we've seen recently from regulators is if it's in your security instrument, if it's in the mortgage and it indicates and it has those blanket provisions, then you either have to have the information removed from your mortgage, which is not likely because most of those are boilerplate, or the bottom line is if you take the contents as collateral and you have those blanket provisions, then you have to have contents coverage and it should be in the appropriate amount. So that's a big issue.
Yeah. Well, it does seem reasonable. I mean, if contents are being secured, coverage would be required, I would think.
Yeah, well, no, that's correct, Len. However, the issue really relates to those blanket provisions, as I was indicating before. I think lenders generally do a pretty good job. If they know that contents is securing a transaction, they do a really good job of making sure that they have contents coverage for flood. But again, as I indicated, these provisions that are embedded within the mortgage or security agreement, and oftentimes when that happens, lenders, I don't want to say that they just kind of gloss over it, but they don't necessarily understand that they have a responsibility when those blanket provisions are in those security agreements to get contents coverage in the appropriate amount. And I just can't emphasize enough that institutions need to be aware of those provisions, and it's a hot issue.
Okay, well, I'm certain there's some other hot issues regarding flood insurance as well. What other issues are you seeing regarding flood insurance?
Yeah, well, I'm glad you asked. And of course, I could probably talk all day long on flood just in itself, but let me just quickly, go over a few of them. I mean, timing issues with ordering determination, as I indicated, I think when we first started out today, I talked about a reasonable period of time, which is interpreted to be 10 days. So we need to make sure we get those determinations out there. More of a problem probably on the home equity line of credit side of things because of how quick those are turned around. So you have to meet the reasonableness standard. So in those particular cases, I always say if you're doing the home equity and you can turn those things over in 24 hours and you've complied with the requirements of determining whether the property's in a flood zone, provide a notification and have a policy in place, then close the loan. So in other words, you've satisfied the reasonableness standard for procuring a policy. The notification, as I indicated before, for the need of insurance, return receipt requested. I think that's critical. We don't need proof of mailing. We need proof that they received it. As I indicated before, too, the calculation of coverage, making sure that we're using replacement cost value and documenting replacement cost value and documenting our methodology of arriving at replacement cost value. And what I mean by that is it's not just taking an appraisal deducting the land and using that figure. You have to use a myriad of sources. Go to the tax bill, go to the replacement cost on the homeowner's bill, do the appraisal, and then support that methodology of how you arrived at replacement cost. Use construction cost if you have to. If it's a commercial property, we're using actual cash value. So we have to be aware of that, make sure we calculate accurately. Reconciling your records with your life of loan monitoring company to ensure that ongoing coverage is adequate, and making sure that we have good, strong controls for monitoring for ongoing coverage, and those policies renew. So we have to make sure we have a new policy in place. And if not, we have to force place accordingly. And failure to force place timely can get us in a hell of a lot of trouble. So we got to be very, very careful with the requirements and make sure that we're doing what we say we're going to do. Don't force place a partial policy, as I just indicated. And then make sure that you properly vet private insurance policies, because those, again, if they're not carrying the compliance component, could be problematic for an institution. And as you can see, it's a broad range of issues, and any one of them can result in an enforcement action or civil money penalty. So it's imperative for these institutions to take floods seriously. And as easy as it is to comply, we, again, are seeing issues in that particular arena. So tighten the bootstraps, as they say. Hello?
Well, Dean, you've provided some very important information to clarify what's been a very confusing issue for many bankers today. And I'm certain that many of them will listen and re-listen to this because you provided so much valuable information. This is Len Suzio from GeoDataVision.
And this is Dean Stockford from M&M Consulting saying thank you for listening to today's podcast. And please let us know of any additional topics you'd like to hear in future podcasts.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and GeoDataVision on LinkedIn for all the latest news and information on compliance hot topics.